Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. An hour away from the opening trade, here's what you need to know. Spending cuts and tax hikes on business and the wealthy. The French budget's €60 billion effort to tackle its debt pile. We'll bring you all the details. US core inflation comes in hotter than expected and the jobs market continues to show cracks. European futures are flat, though, while Chinese indices soften on stimulus concerns. And Tesla's long-awaited Robotaxi is here. Elon Musk unveils the prototype at a glitzy event in California, saying production may start in 2026.
In the meantime, a quick check on these markets. When you look at the futures picture, it's a little quiet. You are seeing marginal outperformers, but emphasis on marginal. Only higher by 1/10% on FTSE 100. Eurostoxx 50 futures basically flat in the moment. A U.S. 10-year coming off that data we saw in the last 24 hours of the States, right below 4%. 397 is where we're at there. But, of course, as those French bonds open, I believe we're about 30 minutes away. That's going to move euro-dollar 109.34 on that currency pair. The countdown to the opening trade starts right now.
Friday the 11th, good morning. Taxes and taxis are on the agenda this morning. Let's start off with the former and figure out what's happening in France.
Yeah, absolutely. The French budget very much in focus. 440 companies and 65,000 households going to see increases in tax as a result of what we're doing here. And what stands out really is firstly that, of course, France has the biggest tax take in Europe as a percentage of GDP already.
Yeah, already.
And this really flies in the face of not everything, but a lot of what Macron has been trying to do, trying to tempt bankers over to Paris post-Brexit, reforming the wealth tax to try and make that less of a hindrance. And there's been some evidence it was successful. So really a change of direction in Paris.
But ultimately not addressing how you stimulate growth in the long term. This is really kind of a filling a shortfall, if you will, on the funding in the short term. When you start to see a lot of CEOs complain about it, I wonder how long this will last.
How long will it last? It's meant to be for 2 years. Some of these taxes are meant to be temporary. But you look at what is happening here in the UK, a lot of talk about people leaving as a result of the increased taxes. You could already argue that France had already some fairly onerous taxes. And it's surprising, you could argue, if that was the case, that so many people have stayed. The debate really is around how mobile some of this capital is.
Yes.
How much will leave?
Yes, how much will leave? Where will it go to? Dubai, perhaps? Lionel Laurent has that suggestion. Kriti, on to some of the macro data.
Yeah, there's other pieces of it. I should quickly mention that France is also planning to sell 300 billion euros of bonds in addition to increasing taxes as well. So fundraising certainly top of mind. But globally, we're looking at U.S. data as well. That's going to be crucial. CPI numbers yesterday came in slightly hot, but still kind of suggested the deceleration in inflation is where we're headed. Jobless claims seem to be the juicier part.
It's fascinating, isn't it? And that's where the market focuses its attention. And it's the labour market still, front and centre, rather the inflation numbers. The market's convinced inflation is done and the labour market remains the issue, and that's where the job cuts are going to be coming from.
Yeah, let's bring in Bloomberg's Valerie Teitel. She, of course, is standing by to talk about all of this and to break down some of the data and the market reaction we got on the back of it. Valerie, over to you.
Hey, Kriti, I just want to focus a little bit on those jobless claims figures that we got yesterday. It was the biggest jump week on week that we've seen in 3 years, and the overall level has jumped to the highest level in this year alone. Now, it was funny, we got this release alongside that hot CPI print, and again, if we take a look at the market reaction, it was way more focused on this negative news we got from the labor market. We saw two-year yields rally 6 basis points as both these data points were released. It really goes to show, it confirms our suspicion that, yes, we are more sensitive to weak labor market news rather than any hot inflation number prints.
Certainly something you're going to be keeping an eye on. And Valerie, of course, is that bond market picture that you leave us with. We thank you so much for breaking it down. But Anna, as she was talking about that, 397 on the 2-year, 406 on the 10-year. We're seeing some big market swings. They're not unlikely to stop in the lead up to the U.S. election. And yet, kind of range-bound. I don't really know what to make with this bond market.
Right, and we've had plenty of interesting conversations on that front in recent days. 3 Fed officials weighing in post-CPI, suggesting, at least in the words of our colleagues at Bloomberg News, that they're kind of unfazed by what we've seen here, this pop in CPI, if that's the right word for it, core a little higher than expected. They're not too fazed by it. Bostic a little bit, though, maybe of an outlier. I mean, suggesting that maybe he'd be comfortable with at least a skip this time around.
Yeah, are they going to go every time? Have we taken 50 firmly off the table? It certainly feels like that probably is the case right now. I guess you probably need to see more on the inflation front to start to freak people out again. That seems to be still the case. We're still in the paradigm where the labour market is the more dominant theme.
Yeah, you said 50 potentially off the table. Some saying 25 off the table as well.
Exactly.
But I think that brings up the question of credibility, and that's really where the Fed is getting stuck here, because now with a 50 basis point cut, Does a pause mean they made a mistake? Does a pause mean less of a pattern moving forward? I don't know what you do with that.
Talking of credibility, let's talk about what is happening at Tesla. Is the Robotaxi the right product? Is that what we need right now? BI, Bloomberg Intelligence, talking about the fact that actually what Tesla really needs right now is a $38,000 car rather than a taxi without a steering wheel or without pedals. But that's what we got last night. There is Elon Musk climbing into the vehicle, his concept car for the future. I find it fascinating that it still looks like a car in some ways. It still looks like a vehicle that we would recognise as a normal kind of a car. They also, the other surprise...
I mean, a little bit space age, but yeah, it's car-shaped.
It's car-shaped. You could put a steering wheel in there and imagine people driving it.
I suppose that's something to do with aerodynamics and physics. I'll leave that to the car
I think it probably is to do with the latter, but are other people going to be able to mess around with this and make it something that actually is more... in a London taxi, you have plenty of sort of optionality in terms of where you sit.
Yeah.
In that, you don't. But I guess a New York taxi, you probably get in the back, don't you? And you get used to that
There
concept.
is also the option of a robo-van that apparently seats
That's the
20.
surprise.
Yes. 20 people in that one. I mean, that sounds like a bus, doesn't it? But I like the fact that Bloomberg Intelligence, you mentioned them, they also talk about how there is a limit currently on the number of vehicles that are allowed on US roads with no steering wheel, and it's 2,500. And it's that change, a change in that kind of regulatory environment that perhaps Musk needs next.
And that's exactly where he doesn't have friends right now in the regulatory environment. So we'll see how much
He might have
changes.
friends soon.
He might, but so much of the Tesla kind of growth story has been a subsidy story. It's been a government subsidy story, and I don't know if that continues in a new regime.
How much more flexibility would there be for Tesla doing what it wants to do if Trump were to win the presidency? I think is a key question, given their close relationship right now.
Despite the pull away from some of the climate change agenda, et cetera?
I think there's all kinds of things that could change. Flexibility is important. It's interesting that they start in the most liberal states in terms of where they could potentially push this product through. Let's talk about what we're going to be talking about over the next few hours. We've already laid out the agenda. Let's talk about the guests that we're going to be talking to. Melanie Baker from Royal London Asset Management will unpack yesterday's CPI inflation print for us and the labour market story. Citi's Christian Bitterly is going to be joining us for the opening trade. That's at 8 o'clock UK time. At 8:30, we're going to get reaction to the French budget. We got that from Michel Barnier. We're going to get an update from his government, a junior minister, the Minister for European Relations, Benjamin Haddad, is going to be joining us a little bit later, Chrissy.
Plenty of good conversations ahead on the show. Plenty of data to watch as well and moments throughout the next 24 hours as well. At 10 a.m. UK time, we're going to get an announcement, a very special announcement from the Nobel Peace Prize Committee. We're going to see really who wins that. There's a lot of conflict in the world. We're, of course, certainly have some suspicions around who is going to be the winner there. At 12 p.m. UK time, earnings season kicks off in the States with those banks. JP Morgan, Wells Fargo, both reporting this morning over in New York. We're going to keep an eye on that, what kind of tone it sets for the banking story and the earnings story for the rest of the world. Plus, at 1:30 p.m. UK time, does the PPI data show what the CPI data did? We're going to keep an eye on that. Plus, more Fed speak. Goolsbee, Logan, Bowman, all hitting the table. More on the hawkish tilt, Anna. But we'll see whether or not that mirrors some of the other comments we've heard.
Yes, and focusing on the banking story, interesting, we heard from JP Morgan just around a month ago, I think it was, when Daniel Pinto was speaking and saying analysts were being too optimistic on NII, on net interest income. So we'll see with the rate cut environment and all that conversation ongoing, what impact that has there. Plenty of themes, though, to dive into with the banks around regulation, around expenses, NII I've mentioned, the election, M&A, that's a perennial topic.
What I want to know about is what is happening with the consumer, what is happening with the business story, what is happening with consumer sentiment, what's happening with business sentiment. Is this an economy that feels like it's re-accelerating or slowing down? JP Morgan very much has the data to be able to give us a pretty solid steer on what is happening there.
In terms of loan growth as well, right? Because they're, and I would argue even trading volatility, so much of the growth in the absence of the IPO market and the capital markets activity has shown them in the volatility of these markets. You see some clarity, which our guests on the show have said there won't be for a couple of months now. Does that actually hit their bottom line as well? We should also mention the other banking story we have our eye on. TD Bank, a top 10 bank, Canadian bank, but a top 10 bank in the States as well, getting fined $3 billion for crimes associated to money laundering. This is a big deal because it's the first major bank globally that's been held accountable for this.
Not only the fine, but also restrictions in terms of how it's going to operate going forward from here, which is going to be significant in its ability to continue to grow. Let's talk about what else you're going to be needing to know this morning. Bloomberg has learned that Clayton, Dubliner and Rice is nearing a deal to acquire Sanofi's consumer health unit for about 15 billion euros. We understand that the private equity firm has seen off interest from rival PI partners for that business. It's potentially one of the largest transactions we could see in Europe this year, and a number of spin-offs have been making headlines on this front. Stellantis is replacing its finance chief as part of a broad management overhaul as it tries to regain investor trust and stabilise its business. Its CFO, Natalie Knight, will leave the company and be replaced by Doug Osterman. Knight, who joined the carmaker last year, faced a backlash over last month's profit warning. And shares in AMD have fallen the most in more than a month after it unveiled a new set of AI chips. But it failed to provide information on the financial performance that investors had been hoping for. CEO Lisa Su told Bloomberg the market, though, is growing incredibly fast.
This is an incredibly fast-growing market. I mean, if you think about, what we've done just over the last 12 months or so, we've seen MI300 demand increase from when we started the year to, in our most recent earnings, we actually said we would be over $4.5 billion in this important AI accelerator market.
Kriti, the market wasn't impressed. They're waiting for more. They need more detail. We need some of the NVIDIA buzz, maybe, for AMD. They're catching up. They're doing well. Completely different strategy, though. They're going for the kind of open source strategy. NVIDIA is trying to capture all elements of the business. It's trying to provide software. It's trying to basically create a closed loop in terms of how the AI story is going to progress. AMD is taking a different approach. Which one will prove to be the most positive?
Well, the stock dropping, I believe, 4 to 5% in yesterday's trade over in the States. But this is significant, Anna, in terms of the idea that, yes, it's a competitor to NVIDIA, but if you look at the street commentary around it, they can't monetize it the way that NVIDIA can. Yep. This is, I think, part of the argument that you've had from the regulatory authorities on NVIDIA as well, is that the barriers to entry are too high because NVIDIA dominates the space.
And that's what was a bit disappointing about yesterday. It wasn't necessarily around product. It was around the lack of detail on customers and financials. But we do have a date to look forward to some more information on the financials, obviously, and so more forthcoming there. So it was a bit of a tumble for the stock, but only 4%? I don't know. It doesn't feel huge in the world of AI, but we'll see where this one goes from here. But nice to mention the closest rival to NVIDIA and how it is faring. Coming up on the programme, we'll get back to more corporate news. We'll check in on Sanofi shares at the open amid reports that major deal that Guy was just referencing earlier on is being discussed. Plus, more on the French budget in our exclusive interview with Benjamin Haddad, France's Minister Delegate for European Affairs. Up next, core inflation comes in hotter than expected in the US. We'll dig deeper into the economic tea leaves in that conversation. If you want to get involved in our conversations this Friday morning and every morning, you can get in touch. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
From the Fed's perspective, look, if the economy's in good shape, we can just gradually bring rates back to a normal level.
The Fed is on an easing path, and I think that's what's important. If you look at the distribution of what's being priced in the SOFR market or the futures market, traders and investors are really thinking, okay, the Fed is protecting the downside here.
We're not sure the Fed has everything under control the way that they want to, and that is a risk. The last thing the Fed wants to do is stoke those flames of inflation, have that move higher as we head into the end of the year, and have to actually raise rates again.
Inflation is still slightly above the target, but is falling. And the fact that it's actually not falling as much is a signal that economic growth is actually not even a soft landing scenario, but maybe in a no landing scenario.
I think my biggest takeaway from that is that Greg Peters is an Arsenal fan, but we'll park that one for the time being. Some of our guests talking about the hotter-than-expected CPI print out of the United States yesterday. The market seems to be reacting quite strongly as well to the claims numbers we saw. We also saw 3 Fed officials shrugging off that higher-than-anticipated forecast, suggesting the central bank, as we've just been hearing, can continue with its rate-cutting moves. We're joined now to add another voice into this conversation. Melanie Baker, senior economist at Royal London Asset Management, sitting around the table with us this morning. The market seemed to focus on the labour market rather than the inflation data yesterday, in terms of the reaction that we got. Is that a mistake? Is this inflation number significant?
I think it's a little more important at this point than the claims data, just because the claims data, I think, has been a bit distorted by hurricane. I think it will continue to be the case given what we've just seen. I'd be a little bit careful with the claims data at the moment. It does move up and down. And the broad trend in the claims data hasn't been particularly alarming. On the CPI data, that was interesting, right? That's the second consecutive month of a sort of 0.3 on core inflation. It's not quite as inflation target consistent as it was. And I think it's a genuine question to ask about how fast the Fed are going to cut rates here.
Yeah. Is that because the easy yard to be made in terms of bringing inflation back down, the disinflationary process, the supply chain story that's kind of fixed itself, that's the easy bit, and now the hard bit comes. We always kind of knew that there was a hard bit. Is that where we are now? That's
potentially a bit of it, yeah. I mean, I think if you look across economies, you've got a bit of a problem with sticky services inflation as a sort of general theme. Just that services bit of inflation kind of not coming down quite as quickly as I think many economists had sort of hoped. Yeah. So I think there's a bit of that, yeah. Look, if you look at the data yesterday, I mean, some of that sort of upside surprise was in, I think the strong sort of moves on the month were in the more volatile categories, so the sort of, the apparel and the airfares.
Yeah, sure.
I wouldn't take it too far, but it's just that second consecutive month, things just looking a little less comfortable than they were.
Melanie, good morning. I mean, so that number coming in, the core number coming in a little hotter than expected. How much does this make you think about, medium term? What should our expectations be about where inflation settles? I mean, sure, the Fed hasn't changed its inflation target, nor have other central banks, but there are plenty of voices talking about how the world we live in now is more inflationary than the pre-COVID world. Is that something you think about? It is something I think about, yeah. I'm particularly sort of medium to long term thinking about risks around demographics, around climate change and how those may prove inflationary, maybe a bit more prone to inflation spikes in coming years. Yeah, absolutely, it's something I think about. I mean, at the moment, I'm not assuming that the Fed moves away from its sort of 2% inflation target, but I think that's a general theme. It's not just a US theme either. So if the Fed doesn't move its target, do economists in general just assume that we still get back to target, or do they shift their medium-term expectations of where inflation goes because of the comments you made there? I mean, we heard from Jamie Dimon earlier this week talking about those and other drivers, trade, for example, trade policy and tariffs and all the other things that could be inflationary. And it also affects, of course, where you think the interest rates are going to be able to settle as well. So, yeah, I mean, I think if I look at my forecast for sort of medium-term forecast for a number of economies, I have inflation sort of settling just a bit above target. It's that idea that, on average, it might be a little bit above target for those reasons.
Critics of Powell's and the Fed's 50 basis point cut would say the economy is still doing very well. Why do we even need a cut right now? But I'm curious how much of that 50 basis point cut cushions, perhaps, the market from yield spikes down the road, whether it's election-related or deficit-related or geopolitics-related. How much wiggle room did that cut give the markets?
I'm not sure it gave a huge amount of wiggle room as such. I mean, I do worry that as we go into next year in particular, and the Fed cuts are one thing, but that fiscal backdrop could change quite dramatically in the US. And you've got quite a contrast building in the US on the fiscal side compared to some other economies right now. So, no, I do worry that there's more room for bonds. There's room for bonds to move there.
Are insurance cuts still a relevant tool? And I ask this in the context of course, the Jake Powell insurance cut of 2019 off of tariffs imposed on China during the Trump era. Is that still a relevant tool to use?
So, sorry,
an insurance cut?
Yeah, no, it is absolutely still relevant, yeah. And I think some of that cooling we'd seen in the labour market was, of course, one of the reasons why we saw that 50 basis points recalibration. I don't think the Fed were behind the curve, particularly at that point. But so there's maybe a tiny element of that already in what they've been doing. And I think if the thinking then forward about potential upside risks to growth, depending on the political outcomes of the economy, then they could be a little bit more cautious than they would otherwise, even in advance of some of the policy decisions.
The key question we're all trying to figure out is the US economy speeding up or slowing down?
It's so easy to ask.
It's an easy question to ask, but precisely. And what do you think the answer is right now?
I think it's slowing. I think it's slowing a bit. I'm not overly concerned about it. I just have a little bit of a slowdown and a bit of a cooling in my forecast. Taking across a whole bunch of US data. But I don't think it's a dramatic slowdown at this point. And again, with the Fed cutting, with potentially a bit more fiscal stimulus down the line, who knows? I'm not overly worried that that's a sort of you can extrapolate that.
Melanie, we're going to get an update in the first 100 days of the Labour government in just a moment. Right. We're looking ahead to the budget, though. What's the key thing that because we've had a lot of, I mean, it's not even been news, has it? It's been a lot of talk about what might happen, what the news might be around the budget. Clearly, fiscal headroom is going to be a big focus. How they get growth is going to be a big focus. Yes. What are you watching for?
I'm watching for a number of things, and most of all, I'm looking at messaging and clarity, getting a clearer vision of what they're trying to do and what the next several years are going to look like. At the moment, it feels a little bit messy. The messaging is a little bit confused, and while I had a fairly clear idea post-election, I think about what they're going to do, I'm actually a little bit less clear now, having seen, as you talk about, that wealth of news reports and press reports.
OK, Melanie, thank you very much. Melanie Baker, Senior Economist at Royal London Asset Management. We will, of course, be trying to fill what has been a lack of clarity, fill that with clarity as we get closer to the budget. But thinking about that mark, that 100 days mark of Starmer's Labour government, our UK correspondent, Lizzie Burden, is with us. She's been marking the Prime Minister's homework so far. What have you concluded, Lizzie?
That stood out for me from your conversation with Melanie just there was messy. A messy 100 days in government so far. Keir Starmer already reaching for the reset button. We knew that this honeymoon period was going to be brief, given, yes, he got a landslide election victory, but his support was thinly spread across the country. But arguably, it's been shorter than it needed to be because he's given this narrative of economic doom and gloom, a consistent emphasis on that £22 billion hole in the public finances and a failure to separate the fiscal picture from the economic picture. You had those GDP numbers at the top of the hour, a bit of relief for Keir Starmer, and of course inflation back near the Bank of England's target, the BOE getting on with cutting interest rates. And as you mentioned, there are fears of tax hikes in this budget on October the 30th, fears of spending cuts as well. That's been spooking both consumers and business leaders too. Now, at home, it seems like Keir Starmer's summer has been a nightmare. You've had the far-right riots. You've had this row about pensioner subsidies. You've had his refusal to lift a cap on two-child benefits, which means that actually the international picture has been easier for Keir Starmer to deal with. You saw him jetting off to the UN General Assembly. He went to Brussels to meet Ursula von der Leyen, try to reset that UK-EU relationship. Yesterday, he hosted Volodymyr Zelensky at Downing Street. And on Monday, we've got the Investment Summit here in the UK, where Keir Starmer is going to try to show that global financiers are actually optimistic about Labour. Just in time, he's managed to secure his investment minister. You might have heard of her. It's Poppy Gustafsson, the former CEO of Darktrace. So he's trying to rally this interest, but for all that Starmer says he doesn't mind being unpopular, the problem is that actually in the polls, it's not looking good for him. Opinion finds that half of voters don't approve of his performance. More in Common finds that a majority preferred Rishi Sunak, which together means that Labour has a glimmer of hope to get back into power in 5 years.
Lizzie, thank you very much indeed. Lizzie Burden, 100 Days of Labour. Friday morning, good morning, 30 minutes to the opening trades. That's equities. Bonds are already starting to open up across Europe. The French 2-year is open and we are seeing yields higher, i.e. bonds prices are falling. Italy's rolling this morning. Just be aware of that if you're looking at your Bloomberg screen. But actually, it doesn't look like... In fact, I think if you look at the front end of the French curve, a slightly better performance than we're seeing in Germany. So maybe there is some appreciation of what we saw in Paris yesterday with the new budget. Maybe that is the positive takeaway from what we're seeing here. I don't have a price yet. Oh, we are getting a price on the 10-year. The French yields are lower. So at a 10-year tenor, we are seeing yields coming down a bit. So that is in stark contrast to what we're seeing in Germany. So a more positive reaction there, Kriti, in terms of maybe what Michel Barnier delivered yesterday.
Well, early days, early moments.
Oh, yes.
Let's see how long that certainly lasts. Speaking of rolling, though, I'm going to make a hard pivot to another major story that we're watching in the last 24 hours. In a Hollywood-style production, Tesla CEO Elon Musk has unveiled a Robotaxi without a steering wheel and pedals at an event in California.
We expect to be in production with the Cybercab, which is really highly optimized for autonomous transport in probably, well, I tend to be a little optimistic with timeframes, but in 2026.
Let's bring in Bloomberg's Katrina Nicholas, who's been, of course, following the story. Katrina, pleasure to have you on the program. There's a lot of hype leading up to this event. Did it live up to it?
Look, well, certainly a lot of hype. Held today at a movie studio at Warner Brothers in LA. The event itself was delayed by about an hour due to a medical emergency in the crowd. And by the time it did get underway, there were over 1 million people watching it online. A very futuristic-looking car drove itself out. The doors opened up like butterfly wings, and Musk stepped in, and off he went for a ride. Really interesting to note, as you said, that this car has no steering wheel or pedals, and that's something that is very hard to engineer, and especially when it has to brake and all be totally sort of camera-based. And there were some 50 fully autonomous so-called Cybercabs and Model Ys driving around this movie studio lot that people could interact with and hop in and go for a ride. Musk said this Cybercab should be available in 2026, and then he sort of hedged himself. He said at least before 2027, and cost below $30,000 US. Also on display, we saw a prototype of a robo-van that Musk said could transport up to 20 people at a time. And also present was Tesla's Optimus humanoid robot, which Musk said could, do basically whatever you want, babysit your kids, take your dogs for a walk, mow your lawn. And indeed, we saw it there at the event. It was behind a bar serving drinks to some people. At the end, there were north of 3 million people watching this event online. And even though the event itself, I guess, was pretty brief, it was over and done with in about 40 minutes.
Yeah, the van looks amazing. The van looks less like a kind of normal, traditional car than we would normally expect, but the Robotaxi certainly does. How sceptical should we be? Even Elon Musk admits that he has a flexible kind of view of time and sticking to deadlines. Is this something that is going to be delivered upon? Is this something that is going to become real within the kind of time frame that he's talking about?
Yeah, well, I think the jury is really out on that one, because there wasn't a lot of detail at this event. There was that $30,000 number, but outside of that, it was pretty light on any other sort of facts and figures. There's also been a lot of talk in the past about this idea of a robo-taxi fleet. So if you had a Tesla and it was autonomous, you could sort of rent it out when you weren't driving it. And Musk did say a little bit about that, how, it could be like people would have a little fleet of their own cars like sheep that they could tend to, but I mean there really wasn't much other detail. And I think analysts are going to be quite skeptical of this $30,000 price point and the timeline, because as you said, I mean Musk has just completely blown past timelines before. If you look at the Cybertruck, for example, that was first unveiled back in 2019, and it didn't actually go into production until late last year. There also wasn't any detail of a cheaper car, and that's something that people have been watching out for a long time, something perhaps closer to the $25K price point that would certainly help perk up EV sales for Tesla. And there also wasn't a huge amount of detail on how Tesla is going to advance its so-called full self-driving technology to the point where, as a driver, you really wouldn't have to need any driver supervision. So, I heard some analysts sort of say that this was more of a controlled demonstration rather than a fully fledged presentation from Tesla.
OK, Katrina, thank you very much. Katrina Nicholas, thanks for joining us on that particular story. We're just getting a red headline across the Bloomberg terminal on Sanofi, and this picking up on some news that we had here at Bloomberg overnight. Sanofi is in talks to sell 50% of its consumer health unit to CD&R. This was a story that Guy was mentioning in the first part of the programme. They've entered into negotiations with CD&R. This is a potential sale of a 50% controlling stake in Opella. This is his over-the-counter consumer health business, I guess, guess it follows on hot on the heels of other businesses within the pharma sector. I think of GSK here, who have also spun off consumer healthcare businesses. So we'll try and get an update on that story, one that Bloomberg had overnight. On to other corporate news flow, but sticking once again, or back to the car sector, Stellantis has announced the departure of its CFO as it seeks to regain investor trust and stabilise the business. Natalie Knight only joined the car maker last year, but faced a backlash over last month's profit warning. Let's bring in Bloomberg's Oliver Crook in Berlin. Oliver, so Knight is departing, part of a broad management shake-up at Stellantis then. What do we know?
Yeah, listen, Anna, something needed to happen after that profit warning 2 weeks ago that really sent shares careening lower after what had already been a very challenging year for Stellantis, and the shares are already very depressed. And that challenge to that came at a management shakeup, not just the CFO departing, the COO, the change in the COOs in both North America and China, replacements at the Maserati and Alfa Romeo brands. So this is really what Carlos Tavares is responding to those sorts of actions after 2 days of board meetings over in the United States. And of course, we've been talking about the difficulties in the auto space. A few of them are also pretty idiosyncratic to Stellantis. They have a lot of inventory that's sitting over in the United States. They've had issues with the unions. And if that wasn't enough, Tavares went from sort of those meetings in the United States to testify before Italian Parliament, because the Italians are very concerned about factory capacity and possible job cuts over in Italy. So for Carlos Tavares, we should also say that this is going to be his last year as CEO. That was sort of confirmed yesterday. His contract is up at the end or the beginning of 2026. For the next year for Carlos Tavares, it's going to be all about whether he can both weather this storm and also bring new exciting cars to market. And that's exactly what we're going to ask him about how he plans to do that when we speak to him on Monday from the Paris Auto Show.
Yeah, really looking forward to that conversation, seeing what he has to say. Huge changes. RBC making the point that maybe the management story isn't really where the problem lies right now. We're beginning to get an understanding, Ollie, of why the Germans are so worried about putting tariffs on Chinese cars. Because Mercedes and BMW sell a lot of cars in China, or do they?
Yeah, a lot less than they did a year ago, and that's sort of the number that we got from the sort of delivery figures that we got from the third quarter from both Mercedes and BMW. We should say overall sales were much lower across the board, right? BMW sales were down 13% and Mercedes 3%. That's globally. When you look at China, it's absolutely staggering. You see the Mercedes sales were down 13%. When you look at BMW, they lost 30% in the Chinese market, and that is their single biggest market. So you just need to think about the scale, and that is before we've gotten any kind of retaliation for those EV tariffs here over in Europe. I think there is one silver lining, because I want to have a little bit of positivity here in the auto sector for at least BMW, because there's also an electric story here. BMW has really continued to buck the trend, managed to get 10% increase in battery electric vehicle sales in the third quarter. You contrast that to what we saw at Mercedes, with a loss of, again, 30%. So it's a very thin silver lining for BMW in what is otherwise a very negative picture, again, in the third quarter for the auto sector.
Ollie, definitely going to be focused on this sector for the next few days. Really looking forward to the coverage. Thank you very much indeed. Oliver Crook joining us out of Berlin. So he's going to be going from Berlin to Paris. The motor show is going to be kicking off Monday. He's going to be speaking to the CEO of Stellantis. Got a host of other leading figures from the European auto industry. What message, Kriti, are we going to be getting? Stellantis, front and centre. Looking forward to that conversation very much.
I mean, it's a fascinating one that you're starting to see this signs of, I think, for the last year, it's kind of been almost a helplessness in dealing with this overcapacity story that you're seeing in the bottom line numbers. Now, with this 45% increase in tariffs, they're fighting back. Europe is fighting back when it comes to that Chinese overcapacity. I asked the Undersecretary of the State Department, Jose Fernandez, who oversees the energy, critical minerals, and environment piece of the State Department. Take a listen to what he had to say about that relationship between China and the auto space.
In the automobile sector, competition from China is undercutting European cars, and a lot of that is that it's state-owned enterprises that don't really have a profit and loss model. They're getting subsidies. They're not paying rent. They're not paying taxes. If they lose money, they just get more money, and they are, companies in Europe have come to the conclusion that that kind of industrial policy is not fair.
leveling the playing field. That's the message in that exclusive interview from the Undersecretary of the State Department. And Guyana, they're really talking about this idea that this overcapacity is unacceptable, not just in the EV space, because that's been a topic for Europe as well. He talked about lithium, he talked about cobalt, he talked about steel, copper, etc. We're now seeing a similar line from Nippon Steel as well. They're talking about their joint venture with Calvert, which is also a steel maker that they're doing with ArcelorMittal. This is all important because you're starting to see in the steel space, in the commodity space, a lot of redirection to cater to some of the geopolitics.
Yeah, I mean, the US State Department making the case there for tariffs, I suppose, and talking about the level of support that Chinese businesses get, specifically in the car sector, but you're widening that conversation out, I suppose. But, you know, really just homing in on what that leads to in Western economies, a much more activist industrial policy, tax incentives, as we've seen with the IRA, to try and take on the competition when the playing field is not level.
Anything you can do, I can do better, seems to be the message. If you're going to do subsidies and tariffs, we're going to do subsidies and tariffs. We'll meet your subsidies with our tariffs. Yeah. But here's the problem with all of this. If we, particularly here in Europe, want to get to our net zero targets, can we do it without Chinese solar, without Chinese EVs?
That's what we were talking to the autos analyst about yesterday, wasn't it? About, you know, China, if one of the things we're missing here is a cheap enough electric vehicle, China has plenty of them, but we're just not sure in Europe if we really want to receive those in large number.
Yeah, it's fascinating when he's talking about the pricing as well. And I think it was Horst Schneider yesterday who talked about that. And this is the conversation the State Department is having as well, and that they're trying to find these alternate sources of the supply chain. We're going to hear a little bit from him later in the show as well. But I think this is crucial because the line that the U.S. loves to say is that this isn't decoupling, this is de-risking. This is building on the supply chain security post-COVID.
Well, and you talk to CEOs and about that, de-risking, not decoupling, and it's all about optionality in your supply chain or regionalisation of your supply chain. So you supply America from Mexico, or you supply...
But there are costs.
Yeah.
But there are costs
and there's
with
inflation, perhaps.
Exactly, and that is the cost.
And that's what we're trying to get at with Melanie Baker. You know, we're all still obsessing about whether inflation gets back to various central banks' targets. I mean, are those central bank targets the right targets now, given the world we live in and the pressures that might be upward on inflation in the medium term?
Yeah, a lot of catch-up to do in the auto space. Horst Schneider talking about a 15-year lag relative to China, and then a lot of catch-up to do, to your point, in the monetary space as well. There's a lot that we have to talk about. We're going to dive into the French side of this. We're talking about Stellantis. We're going to talk about it from a budget point of view. Coming up on the program, France's new budget. We look at the shares most likely to be hit. It may include Stellantis. They may look at the other corporates that are over $1 billion and are going to get hit with the biggest taxes. That and more in your stocks to watch next. Stick with us. This is Bloomberg.
Welcome back. This is the opening trade. It is Friday. We are expecting, well, unchanged markets at the start of the trading day. It seems as if we're not expecting to go anywhere in a hurry. A little bit of upside, perhaps. In terms of the US futures story, that is looking pretty flat as well. Slightly negative, but not by much. Joining us now, Markets Live Executive Editor Mark Cudmore. Mark, let's talk about the markets in 3 minutes. Are you drawn to a focus on inflation and inflation risks after that core CPI number yesterday, or are you still worried about cracks in the labour market? How did you digest that data?
I think it kind of confirmed my prior view, which is always a bit dangerous in markets. As you know, I generally feel there's a lot of upside still in US front-end yields. I think the market is overly complacent about inflation, and I think we're far too worried about labour market. I do not think the initial claims yesterday particularly changed that. As you know, I think that's a very, very important indicator. It was partially why I wasn't too worried about the labour market. But of course, this was in a week that was disrupted by the hurricane. My overall view is that the US economy remains very strong, that yields will go higher as a result because we've priced in too many cuts in the curve, and that the stock market will be okay with that. It's not going to love it because it's already a very expensive stock market, but earnings are going to be perfectly fine. We know that from the macro level. The consumer has still been strong in this sector, so earnings should be good. We should see equities higher into year end, but it'll remain volatile because they're already so expensive.
How much higher? Are we in a holding pattern now with US stocks, or do they just continue to climb? If you've got yields moving north of 4% on a 10-year, if you've got pressure, maybe potentially from the Fed coming through with less cuts, how much higher can stocks really go with just earnings as a driver?
I think they can go a lot higher still because it's not just earnings. There's massive amount of liquidity in the system, and people have been cynical fighting this rally for a long period of time. So I think their tailwinds here are not just earnings, but we've also got the fact that people have just been way too negative on the economy. So you've got better growth, you've got better earnings. You're still going to have this fiscal tailwind that's not going to go away because of the US presidential election. And you still don't seem to have particularly expensive energy prices despite the disruption in the Middle East. So I think there are many tailwinds out there, and the only headwind is that the monetary policy won't be as easy as people thought. But that's because the economy is so strong. That's why monetary policy won't be as easy. So I think there are a lot of tailwinds for stocks still. I think they can still go an awful lot higher, but I think it'll be more volatile because they are expensive.
Mark, let's talk about your other expertise, and that's the FX story. I want to see what is moving euro-dollar here. We're at a 109.37 read on euro-dollar at the moment. Does the budget conversation in Europe even matter, or is this all about the U.S. election when it comes to that currency pair?
I think there are two aspects. I mean, normally dollar's the bigger driver of euro-dollar out there, but I think there's just real deep negativity around Europe. You could say that for most of the last 16, 17 years, but I feel it's particularly intensifying again. You know, people are realizing the US economy is doing well. China's stimulating, so maybe Chinese economy will do better. A lot of the rest of the world was doing okay already, but European growth continues to get worse and worse. And this is the sector where interest rates might still have to be aggressive, or even more aggressive than we're priced, even as we're going to price it some of the rate cuts in the US. So I think that negativity in Europe's going to remain really strong. I see more downs in euro-dollar into the US election. Don't know after that.
All right, Bloomberg Markets Live executive editor Mark Cudmore. Remember, you can get up-to-date analysis from him and the rest of the team. Just type in MLIV Go on your Bloomberg terminal. Well, Mark says maybe the budget may not matter as much to euro-dollar, but it's certainly going to matter when we look at the open of stocks. It's going to be something we talk about in terms of the market read-through. We are also waiting live photos with the French Finance Minister, Antoine Armand, at the National Assembly. Oh, well, there they are. We are waiting for what those kind of comments look like off, of course, the back of Michel Barnier's budget last night.
Yeah, absolutely. And as a result of that budget, 440 companies, 65,000 households paying more in tax. And no doubt some of the pressure he's going to feel here is about explaining those tax increases, but perhaps more likely the pressure domestically is about explaining cuts to spending and how they prioritise certain spending cuts, because we know that's 2/3 of the way that they fix their colossal, as he calls it, budget hole. Yeah, that's what Michel Barnier described it as. Is this a story that is going to slow French growth further? Is this a story that is going to restrict the ability of France to grow out of its problems? It feels like that at the moment. I keep drawing parallels with what's happening here in the UK. At the moment, the message here in the UK is quite doom and gloom. That certainly seems to be coming from the government. But is the budget that is coming up going to be stimulative for the economy net-net? Yes, we are going to be talking about tax cuts, but there could be a big spend element to it. Here, there's more tax than spend. It's tax and cuts. That's the story, rather than tax and spend potentially here in the UK. And you made a good point about the corporate read-through as well, and whether or not that incentivizes or decentivizes. As we know, I was just in Madrid earlier this week, and the conversation there on the ground was how alternative assets, private equity conversations are moving from London to Paris. But the only thing holding it back from doing that is this environment that we're going to see. And it's not just regulation on the tax front, it's regulation when it comes to these alternative assets. Let's get an update then on how stocks might react to the French news. Joe Easton has a briefing. Joe.
Anna, so the French budget could be a key theme today. We are going to be watching some of the sectors most exposed to the rise in corporate taxes over in France. Now, this was Morgan Stanley a week ago writing that they do expect the luxury names to be hit by some of these tax increases. They flagged LVMH, Hermes, Kering and Richemont over in Switzerland as potentially being impacted. One of the main stocks being Hermes, which they said could actually see a decline in earnings per share of up to 9%. So pretty considerable in terms of that impact on that one. We're also going to be looking at travel, given the French are looking to actually increase taxes on plane tickets and other parts of that sector. So we'd keep an eye on Air France, also ADP, which runs the main French airports. Vinci as well, one of the airport concession firms, and a Volta down in duty-free retail. All of those could be in focus today. Then in terms of the UK, we've got some decent share placings in the retail space today. Firstly, for Sainsbury's, the Qataris selling a big chunk of their investment. They've been a long-term owner of Sainsbury's stock, buying into it back in 2007 and offloading a chunk of it today. We can see actually Sainsbury recovering from a drop earlier in the year, so potentially a good time to be selling that stock at a very slight discount. Also, a share placing coming from THG. This is the online retailer and owner of MyProtein, looking to sell around £75 million worth of stock, with the CEO buying in as they look to demerge one of their business-to-business units. We can see that stock on a terrible run since their IPO a few years ago, down around 90% for that one. Then we've got some breaking news from BP. We weren't really expecting this one, but they have given a bit of a production outlook update, saying that their refining margins do look to have weakened and some of their production will only really be flat year on year, according to the company. It's kind of in line with what we've heard from analysts and also other firms like Exxon and Shell. Here we've got BP on a chart against the Brent crude price. We can see it coming down there. Keep an eye on BP. Finally, in your ratings, we got a couple in Europe this morning. We do have... Well, there's your ratings on BP, 13 buys, only 1 sell, and your ratings to look out for: BASF, Credit Agricole, both downgraded, and Barclays also got Marks & Spencer as a new favourite stock in at London.
Thank you very much, Joe Easton, with the latest on the stocks we're focused on. Hays also could be in focus. This, the recruitment business, total comparable net fees down 14%, so that stock could be under pressure. We got reassuring GDP data out of the UK today, so that's the other side of that story. We'll be back with the market open. This is Bloomberg.
Couple of minutes to go to the opening trade here in Europe. Equities will be opening. Yesterday they didn't do very much from beginning of the session to the end of the session. Kind of feels like we're starting on the same foot this morning. So there's the white line. That's Europe, pretty much flat. US markets almost exactly the same as well, despite the fact we had to price in inflation. We had the claims numbers that we needed to think about as well. There's a lot to think about right now, but equity markets don't seem to have a clear sense of direction, Kriti. Is that going to change this morning?
I don't really know. I feel like I need to pull a Guy Johnson here and say nothing is happening. Nothing's happening, and there's no excitement because take a look at futures. Eurostoxx 50 futures are completely flat, even when we're expecting some movement. Even FTSE 100 doing a whole lot of nothing. Even in the French story, that read-through from the budget, you aren't necessarily seeing it in the futures picture. Anna, rescue me. Maybe there's some more excitement in the micro space.
Oh, there's plenty of excitement. We'll certainly look for any read across into French stocks from what's been happening with the budget, and you've mentioned that, Kriti, this morning. So let's focus on another couple of stocks in focus. Sainsbury's. Do you remember 2007 when the Qataris came in and made took a stake in Sainsbury's and then tried to make an offer for the whole business? That didn't go through. But now they're dialing back that stake. They're selling some of it, and we see them offloading. And so there's a book build happening at Sainsbury's. We'll watch that stock. BP in focus this morning. No change in their capex expectations, but they do see debt increasing in the third quarter. And we've often written about the debt levels over at BP, so we'll continue to focus on that here at Bloomberg. Also keep an eye on Hays, away from the stocks listed on that graphic. This is a recruitment business, and if you're ever looking for cracks in labour markets, always a useful one to watch. And there's a bit of a warning there around their revenues. Guy?
Yep, the labour market does seem to be a significant story. Certainly was yesterday for US markets, maybe here in the UK as well. Right, here we go. Friday session is almost upon us. Are we going to see significant movement at the get-go of trade? Let's find out. It's time for the opening trade. These are the initial numbers, and it looks as if London is struggling for a sense of direction already. Let's see exactly where we go with this one. Nobody is expecting these markets to deliver a surprise at the start of trading today, but there's plenty of things for markets to worry about and think about right now. Maybe just not today. Maybe we've got a quieter session in prospect like yesterday. So here we go. Stock 600 barely budging. FTSE 100 barely budging. The IBEX is down by 0.1%. The DAX, which seems remarkably out of the gate, remarkably quickly out of the gate this morning. Clearly nothing going on there because it usually takes a while if there are things to price in. So, yeah, Kriti, you can save me now.
I'm going to toss it quickly to Anna in a moment. But when you look at the FTSE 100, I think what's interesting here is even though on the surface there may be not much happening, commodities are the underperformer. It's not just in the oil sector where you are seeing BP and Shell, your biggest weights on the index. BP taking a beating this morning, down about 1.2%, which we'll dive into in a bit. But you're seeing some of the commodity names as well as even some of the other trading platforms. Glencore, for example, also trading in line with the commodity space. When you look to the other side of the coin, which is, of course, the biggest gainers or the biggest index contributors to the upside. It's Novo Nordisk, it's ASML. It kind of almost feels like on the surface a little bit of a safety trade. That oil move seems to be the biggest one, just following what you're seeing in the broader macro space.
I'm just being, our attention is being drawn by our colleague Oliver Crook to the lines out of Porsche this morning. And Guy, you were talking to Ollie earlier on about the travails of some of the big German manufacturers, particular upper-end cars. Well, Porsche's China sales numbers, they're now out to go alongside the ones from Mercedes yesterday. Porsche's sales plummeting in China during the third quarter, a decline in luxury spending, of course, that we've covered a lot, a shift to local electric brand cars, all of that weighing on this business. So China deliveries fell by 19% in the third quarter. This comes on the back of BMW, Mercedes, also reporting steep quarterly declines in the Chinese market.
You've also got to think about this in the fact that the EV landscape seems to have levelled the playing field in many ways. You think about a Porsche 911, you think about that kind of a vehicle that has some sort of iconic status. But does the Taycan have the same iconic status? Is it more comparable with other EVs in terms of what you get, the performance you're looking at, that kind of stuff? So it does feel as if the EV landscape is, and the transition makes it more difficult for some of these legacy car makers.
Puts a different complexion on the brand, perhaps, and what people are think it's worth paying for that brand. One of our colleagues at Bloomberg Opinion writing just yesterday about the domestic fight back in China, and yes, it's been at the lower end with entry-level EVs, reasonably priced, the things that Europe doesn't necessarily have so much of, but now actually increasingly focused on the upper end and trying to reclaim some ground within that space. So interesting to watch as the Chinese offering around autos evolves.
We should mention the underperformance in the French index as well. And we're still waiting for some of those numbers to shake out. But you had warned us of this earlier. So had Joe as well. LVMH is taking a beating as well, down about 1%. Sanofi, Total, basically your biggest French names, reacting, underperforming, perhaps in reaction to that French budget.
Some of those 440 companies, perhaps, that will have to pay more tax as a result of this.
Precisely. But let's also think about the fact that LVMH has been moved around an awful lot this week by the China story. We have a briefing tomorrow, I think, from the Ministry of Finance. We've got another briefing coming up at the beginning of next week. Could the story around LVMH change by Monday morning? If the Chinese come through and deliver significant amounts of stimulus, does that read through into the European luxury names where we aren't seeing it in the car sector this morning? That certainly is a factor that we are going to be watching out for. Let's talk a little bit about kind of what is happening with some of the risks that we're watching in these markets as well. We factored in China. We've talked about the tax story here in Europe. But the big story that is hanging over everything right now appears to be the US election. And that's what so many investors are focused on. Nouriel Roubini was talking us through his take on this yesterday. Just take a listen.
I worry that regardless of Harris or Trump, that over the medium term, we have a number of negative aggregate supply shocks that are meaningful. Deglobalization, reshoring, friendshoring, aging, restriction of migration, geopolitical conflict, climate change, pandemics, backlash against the liberal democracy. All these things tend to increase cost of production, reduce growth, and there are stagflation of the medium term. So some of my arguments are independent of whether Harris or Trump will be elected.
Nouriel Roubini there speaking over in the States to our colleagues at the U.S. Open. Let's get another take here. Kristen Bitterly, head of Citi's Global Wealth at Work unit, joins us now around the table. Good morning. It's lovely to see you. Welcome back to London. We're talking a lot about the digestion of geopolitics, of course, in Europe and how that affects things. As Guy said, the overhang is the U.S. election. As Nouriel Roubini said, the overhang is the U.S. election. How do you trade it?
So U.S. elections, I think we have to take a look at the macro backdrop in terms of why U.S. investors are actually quite bullish. And so we've been visiting with a lot of our clients, and the general theme is, okay, if interest rates are coming down, if we're seeing disinflationary forces, if we're seeing record corporate profitability, and then you add things like China stimulus on top of it, it's a very, very positive macro backdrop. I think one thing that we could see within October is just the fact that October in any election year tends to be a negative month. It's just trading that uncertainty and saying, I'm going to take some of my money, some of my gains, particularly in a year like this, off the table. So I think over the next couple of weeks, we could certainly see that. We're seeing that in the options market. When you look at skew within the options market, people are hedging going into this month. So I think waiting for the outcome of the election, and generally once we know that outcome, we tend to see a rally into year end.
You mentioned the China stimulus as well. We'll circle back to the election. But you mentioned the China stimulus. How similar from a trading impact is this package that we're getting relative to the massive influx that we got back in 2009?
So I think it's very different in the sense that we need to wait and see, because two things we need to look at within the Chinese economy as to whether or not this is going to be strategic as opposed to a tactical trade. And so for it to be strategic, you need really two things. You need consumption to increase in that economy. There are various measures that they're taking, but time will tell until we actually see whether that spending manifests. I think the other thing, too, is international investment. One of the massive trends that we've seen over the past couple of years is international capital moving away, going into other parts of Asia, or just the global economy and global markets more broadly. We haven't seen that come back in. A lot of the movement was short covering and local market activity, and we need international investing for that to really have legs.
Yeah, and Chris, is fiscal stimulus, yes, you've mentioned we need some of that, maybe that's part of the story, but that flow of money was made nervous by broader policy. It wasn't just a sluggish Chinese consumer, I assume.
Yep.
So is fixing the Chinese consumer going to be enough to encourage that money
it has to
that
be
went elsewhere?
and it has to be a multi-pronged approach. So when you're looking at everything that they're doing right now to encourage stock buybacks, to stimulate the local economy, I think it needs to hit on all fronts as opposed to just being one element. But consumption is something that everyone's looking for, and that's what's been missing.
Yeah. Back to the United States, how has the cut in 50 basis points sort of triggered conversations with clients? How are people thinking about a slightly lower rates environment? And jury's still out about how quickly those rates come down. But how is that changing the conversations you're having with clients at this point?
So I think cash was a viable asset class for the past couple of years as we saw interest rates go higher and higher. I think now the conversation around, can I continue to generate this yield simply by rolling T-bills? Do I need to actually find other types of instruments within the fixed income market is now becoming a reality, because it's not just the 50 basis point cut, it's what's the trajectory from here. So if you're someone who's been significantly overweight cash, how am I now reallocating that portfolio to have more of a sustainable yield? And I think that's why we're going to see a continued tailwind in terms of the equity markets as well. So with record profitability, with lower interest rates, with a disinflationary environment, and a lot of cash on the sidelines now being mobilized, I think that's what a lot of people are thinking about.
Are we sure rates are coming down? Are we sure inflation's beaten?
Well, I think when we talk about volatile markets, the U.S. rates market is probably one of the most volatile.
We're back about 4% now.
I know, on the 10-year, which is actually, adding exposure there could make some sense. I think the thing that's most important is the trajectory. We could debate whether 50 basis points was the right thing, the wrong thing, should have been 25 basis points. Are we going to get 2 more 25 basis points cuts this year? We could debate that, but I think it really is the trajectory, which is why the data, particularly inflation, you had a little bit of a mixed bag. I think owners' equivalent rents coming down is something that's actually a positive signal. And now it's all eyes on the labor market. If we're in this holding pattern, and we saw a lot of Fed speak this week to this point, if we're in this holding pattern, this is the sweet spot. So I think continuing on a 25 basis point cut trajectory is what we anticipate.
Okay. If you're thinking about kind of what you do next, you've got some cash. Been in a money market account, you're thinking about allocating it. Does it stay in the United States? Does it go elsewhere? Is the argument where is the argument about moving money out of the States?
It's hard. It's a hard argument. I think there's such a natural home bias within U.S. investors more generally. But then when you look at all of those factors, those are tailwinds for the U.S. equity market. I think outside of the U.S. there are certainly opportunities, but it's more idiosyncratic.
How are you feeling about Europe?
So I think that's an idiosyncratic story, actually. I think when you look at some of the growth numbers, not as compelling, you look at that relative value, you could always make a case for valuations, that there would be a stronger case for investing in Europe from a valuation perspective. But I think when you look at the opportunities, when you look at delivering earnings growth, if the U.S. continues to deliver from an earnings growth perspective, you'll see more flows come into the U.S.
What sets it apart, though? Because so many European companies, these major houses, have, say, 60, 70% of their revenue based in the U.S. consumer, and that's kind of been fueling this catch-up trade story. So is it just that the margin growth and the pricing pressure is higher from U.S. corporates? Is that the value add?
I think it's also when you look at how people are accessing the European market, whether it's the UK or broader European market, it tends to be in index-based instruments. And so you have such a strong bias towards more of the value part of the market as opposed to the growth market. And so that's why I think if you're going to access this region more broadly, those idiosyncratic active management makes sense because there are some great, to your point, global companies, when you're looking at their exposure, is it uniquely to the economies in Europe or is it global?
Guy made a key point of that we're above 4%. We may continue to see an uptick in inflation. You made that key point that it's the trajectory that matters. If we start to see early signs in the data that actually inflation is decelerating the deceleration is decelerating. So basically the margin of the move is smaller than the market expected, or there's even these tiny upticks in inflation. How do you trade that?
So I think trading it is not actually where you want to go. So when you look at this data...
How do you hedge it then?
Yeah, so I think from a hedging perspective, I would say be very balanced within your portfolios, and you see this within our portfolios as well, that we have, while we are overweight equities, we have fixed income exposure. It is moving out the curve a little bit in terms of intermediate duration, and it is taking advantage of tools even like preferreds, where you're getting an above market yield. But I think when you look at the economic data, there is a lot of noise in it. So we could find something good in that CPI print. We could also say, the fact that airlines are now higher when we're looking at airfare pricing, is that something that we should really be concerned about? And look at the jobs data that we've just received. You have jobless claims ticking higher. You had a monster jobs report come through just recently. So I think we have to look at overall trend, not just one data point driving that.
What's your degree of certainty in being able to pick that trend right now? The world feels really super confusing compared with previous periods. It really does. I'm looking at a labour market that I'm finding hard to read. Inflation, who knows what's going to happen there? You've got a US election coming up. China stimulus, we don't know what that's going to be on a day-to-day basis. There seems to be a lot of moving parts right now.
I go back to what I said at the beginning of this conversation. You have to basically look at what you know to be true. And if you're seeing record profitability, you're seeing a lot of cash on the sidelines, you're seeing an overarching disinflationary trend, and rates, for the most part, are coming down. So that is all conducive to being invested and to risk assets.
Chris, great to see you. Thanks very much.
Thank you.
Always nice to see you in London. Chris Bidley, head of Citi Global Wealth at Work. Thank you very much indeed. Core 6 looks like this morning. This is what the centre of gravity looks like here in Europe. It is a market that is struggling to find a sense of direction, but you're getting a little bit. LVMH is down. Is that a reaction to the French budget, or is that a reaction to Chinese stimulus and the details we are waiting for? Ferrari's a little soft. Look at Porsche's numbers this morning, particularly out of China. ASML, though, is a little bit more positive. Is that because potentially we are seeing AMD making some moves? I don't know. I find that a little bit of a struggle, but maybe that is why we're seeing some outperformance coming through from the chip sector this morning. But here in Europe, I think we're struggling with a sense of direction. There are some really interesting single stock stories, though, this morning. Joe Easton has them.
So we are seeing some weakness in BP at the open of trading in London. Remember, we had that trading statement a few moments ago from BP talking about weakness in some of their refining margins. Also just production pretty much flattening out quarter on quarter. But that is kind of in line with what we've seen from the other firms and the analyst research recently with the decline in general in the oil price. So that one, a bit of a weight on the FTSE 100 today. Then in terms of some French stocks, now we mentioned luxury, travel, retail, but an analyst contact very kindly flagged that these are some of the most exposed companies to the French tax increases. So they were looking at Safran and Dassault over in aviation, and Fnac Darty in retail, also Eiffage in construction. But as we can see, pretty much remaining quite steady in terms of the reaction there. So potentially this does now look to be priced in by most of the market, but worth keeping an eye on a number of those French stocks. Then in the UK, some decent declines in both Sainsbury's and THG. Share placings for both of these. Sainsbury's, the bigger one, about $400 million worth of stock being sold by the Qataris, long-term investor in that one. And THG is going to be spinning off its Ingenuity platform. Now, that's the BTC retail platform, and they are doing a share placing as well. Cab Payments, meanwhile, now do not trust this price at all, because that stock is going to rise because it is a takeover offer. They've got a takeover bid from a US rival. This is a payments processing firm, cross-border payments, got a bid last night from a US rival, another American company coming to Europe, buying a stock that's listed over here. So we'll wait to get a price on Cab. It was priced in terms of the deal at $145 a share. We're only trading at $121 yesterday, so keep an eye on that one. Then in terms of ratings, a couple of China plays over at JP Morgan. Firstly, they downgrade ArcelorMittal, saying that the company is at risk of potential US tariffs, something we touched upon yesterday alongside that JPM note. Now they are adding Arcelor, and also becoming more bearish on chemicals, so they downgrade Lanxess over in Germany today, and this one is declining as well. That was down a couple of percentage points on Lanxess, ArcelorMittal as well. And another stock is Thales. This one downgraded over there's Lanxess coming down 2%, a decent move on that JPM note. Finally, just Thales over in aerospace, downgraded at Berenberg. That was due to their aerospace satellite division weakening. It's also exposed to defence. There's Thales on the screen, downgraded to hold over at Berenberg, and that one's down 2.6% over in Paris today.
Joe, thank you. Joe Easton from our equities team with an update on some of the movers this morning. Coming up on the programme, more corporate news flow. Sanofi confirms it's in talks with CD&R, Clayton, Dubilier and Rice in what could be one of the biggest deals of the year. More on that next. This is Bloomberg.
20 minutes into the session, this is what the picture looks like. It's very exciting out there, as you can see. We're a little softer on the CAC 40. I think the tax story is certainly rippling through the market this morning. You are seeing it maybe focused on some key stocks. It's interesting, the aviation sector in particular. Take a look at what is happening with what they're doing, for instance, on private jets. That's interesting. That's being taxed. That is a change. And you're seeing it reflected in some of the stock prices as well. But the luxury names are under a little bit of focus too. One stock that does stand out in France, though, this morning is Sanofi. So let's focus on pharma and potentially one of the biggest deals of the year. The company has confirmed that it has entered into talks with CD&R to potentially sell a 50% stake in its consumer health unit. Any deal expected to be worth around 15 billion euros. Eric Fanner, Bloomberg Managing Editor for Global Business, sitting next to me to discuss all of this. In terms of why they're doing it, this seems like a fairly well-trodden path now. We see GSK and other businesses doing this. Is this the same? Is it just basically the consumer and the pharma units going in different directions? Because they're fundamentally different businesses.
Exactly right. I mean, we've seen, as you said, a whole series of these deals. We saw GSK, Novartis, Pfizer, J&J. They've all gotten out of these mass-market consumer goods businesses where they're selling over-the-counter things like toothpaste, pain relief, those sorts of things. It's a very different business model from developing innovative therapies, which takes years, lots of investments in small biotechs, and we're seeing a real shift away from the kind of mega mergers that we saw, the consolidation in the industry for years that developed these big consumer arms alongside the innovative pharma sides.
It's interesting, Eric, the way that this is structured and who was after it, because they're talking about a 50% controlling stake, so it's not a sort of full offload, as we've seen some of the others do. And there was a lot of PE interest in this, wasn't there? There was a lot of competition.
There was indeed, yes. It was a process that went on for about a year with PAI and CD&R at the end. Interested obviously helps for the seller if you've got that kind of competitive interest. That's hence the 15 billion valuation.
Does this pave the way for others though? Or is this kind of a one and done deal?
Well, I mean, we still we'll see more coming out of this one potentially because PE is not necessarily a long-term owner. So we've seen companies like Haleon formed previously from the GSK spin-off.
Why did they go down that different route? Why did GSK look at the spin rather than the sell?
Yeah, that's a good question. I mean, I think some of it might have to do with market conditions at the time. If they had PE interest, in this case, there's slightly different businesses. I think, Haleon has maybe slightly more recognizable brand names, some well-known brand names. It's a slightly bigger entity, potentially, so it could stand alone possibly more easily. But, no matter what, deal making in this sector, we'll see some consolidation probably from these consumer health operations as well. So there'll be more deals to come.
Eric, thank you. Thanks for the briefing. Bloomberg's Eric Fanner with the latest on that particular deal. Let's go from that to the chip sector. Shares in AMD fell the most in more than a month in yesterday's trading session after it unveiled new AI chips but failed to provide the information on financial performance that investors had been hoping for. Bloomberg's Peter Elstrom joins us on this particular story. Peter, good morning. So what did AMD say about its new AI chips? Because I mentioned the disappointment and the things they didn't say, but what did they say about their chips?
That's right. It's not just AMD and its investors that were waiting for this announcement. Really, the whole AI industry is waiting to hear what AMD is going to do here. That's because NVIDIA has essentially a monopoly on the highest-end chips here. It has 90 or 95%. That means that everybody has to pay premium prices in order to get these AI chips that they use to train the AI models that they're using. They want some competition so the prices can come down, innovation can rise. AMD introduced a new set of chips. Lisa Su talked about it. She came on Bloomberg TV to talk about the MI325 chips. She claims that they are more powerful than NVIDIA's high-end chips. But what investors were disappointed by here is that they didn't get more precise details about what demand is going to be like for those chips over the next couple of quarters, what customers are picking up their chips. They want to see that AMD is a real competitor to NVIDIA at this point.
Well, one of the criticisms of NVIDIA by the regulators is that the barriers of entry are simply too high for another player. But NVIDIA and AMD have traded as opposites in so many ways. What barrier of entry does AMD need to surpass, given they, even with those comments from Lisa Su, said we are seeing unstoppable demand?
Well, they're slowly making progress, and there are several different barriers. One of the biggest issues at this point is that NVIDIA is pushing the envelope, pushing the pace so rapidly. They've stepped up innovation to bring out new chips every year, sort of like a consumer product. NVIDIA, Jensen Huang are very aggressive in terms of trying to dominate this market. That's why you've seen their share price really explode over the past couple of years, up to more than $3 trillion at this point. AMD is pushing hard to catch up with them, but they're quite far behind at this point. And of course, there are dozens of other competitors that are also trying to compete with.
Is NVIDIA's strength in its chips or in its ecosystem? Because it has a much more closed-loop setup. It controls kind of the stack completely. AMD's going down a different road.
Yeah, that's exactly right. NVIDIA has been able to build this ecosystem, you're right, because not just the chips, the hardware that they have, but also their CUDA programming language has been able to tie in a lot of the customers that are using these things. Now, people in the industry do want to have alternatives. They want to have lower-priced devices, so even companies like Google would be developing their own chips to be able to operate the AI systems that they have, to be able to bring costs down. But NVIDIA is still very far ahead of the competition so far.
Peter, nice to see you this morning. Thanks for stopping by to update us. Peter Elstrom joining us, our executive editor for Global Technology. Coming up, we're going to turn back to taxes, away from tech. We're going to talk about the French government. It is unveiled, it has unveiled plans for a significant tax hike. It's got spending cuts. All of this, obviously, is now being priced into the bond market. We're not getting a big reaction at the moment, but the market feels like it's on tenterhooks right now. Benjamin Haddad, France's Minister Delegate for European Affairs, is going to be joining us very, very shortly to discuss all of this, and we'll try and put this in a wider European context for you as well. That is coming up. This is Bloomberg.
This is the opening trade. We're at 30 minutes into today's trading session. You are seeing a tilt into negative territory, although marginal moves everywhere but France. The French index is, of course, down by about 0.3%, underperforming its peers. The only green on the screen I'm seeing is actually in Italy, in the FTSE MIB, higher by 0.1%. But again, broadly, sentiment is lower. It's a similar story when you look over at the bond market. It looks like French yields, or French bonds, I should say, are seeing a little bit of a bid, pushing those yields lower, again, in contradiction to something you're seeing in the rest of the continent as well. A lot of that driven by what we've heard in the last 24 hours. France unveiling its budget for the next year, hitting big firms and the wealthy as it looks to trim its colossal debt pile. We are getting live images at the National Assembly at the moment. This is not the French Finance Minister, Antoine Armand, but he is sitting directly to the speaker's left at the moment. So that is something we're going to be monitoring in terms of what they're actually saying and how this all really sets the stage for some sort of comeback, some sort of fundraising for the French government. Let's get a little bit more insight on what these next steps looks like. We are joined this morning out of Paris by Benjamin Haddad, France's Minister Delegate for European Affairs, joining the opening trade this morning. Minister, a pleasure to have you on the program. Thank you so much for making time. Let's kick it off with what we've heard from the last 24 hours out of Michel Barnier and Antoine Armand as well around this French budget. There's a lot of concern from the investor community about whether or not tax hikes are the way to go if it disincentivizes staying in France. What do you say to that?
Look, this is a historic moment of responsibility for France. We're faced with a high deficit, and so the budget that the Prime Minister and the Finance Minister have put forward aims at tackling this debt and deficit over the next few years. We'll be reducing deficit by 60 billion euros, primarily by cutting spending. 2/3 of the budget will focus on cutting spending. We have right now the highest spending in the OECD, so of course this is where we have more margin, so we'll cut across the board and especially tackle structural reforms to be able to be more efficient in the future. Some of that will come through targeted, proportional, and temporary tax hikes on really a small section of the wealthiest companies and individuals. Once again, you know, it's an issue of credibility and responsibility for us towards our partners, towards markets. In the last few years, we've been able to reduce unemployment in France. We've been able to bring back investors. And of course, that's something absolutely key for our trajectory in the next few years.
Credibility and responsibility for France. Those are some key words, of course, Minister. Do you think you're the folks in Brussels, your counterparts at the EU Commission, are viewing it that way?
Yes, and you know that Michel Barnier knows Brussels very well. We are, I think, awaited by our partners on this issue. In the first few years, of the Macron presidency, we had been able to bring back the deficit to 3%, the European rules. But then we've been faced with historical crisis, COVID, the Russian war of aggression on Ukraine. We've put forward spending to protect companies and households. But now it's time to tackle these deficits. Our objective is to bring back the deficit to 3% by 2029, and this is why we're doing this historical effort. Once again, I think we are awaited by our partners in Europe, and they will see today that you have, I think, France rising to this moment and taking these necessary steps.
Minister, good morning. The financial markets see Spain as a better credit than France right now. Is that fair?
Look, I mean, I don't want to go into comparisons of over countries, but what underlines your question is the necessity for us to take these steps, is the necessity to cut spending, and I think this is something that every political force in France in this National Assembly will be faced with. We'll be tackling the budgetary debate at the National Assembly and the Senate in the coming months. And yes, it's true that our partners, markets, our friends across Europe will be looking at France, and this is something that we understand very clearly. And this is why you have, I think, today this budget that's being unveiled that takes a important effort at reducing our deficit, at tackling public spending. And once again, it will be an effort that will be, I think, long-term, structural when it comes to reducing spending.
France came up with the word entrepreneur. If you're an entrepreneur right now, do you think you want to stay? Do you think the level of taxation that you are seeing in France is conducive to those that are generating new business will want and need?
Absolutely you want to stay, because if you look at France over the last few years, it's a great place to do business, and this is what international investors have understood. France has become the most attractive country for international investors in Europe.
But Minister,
we've made it a much friendlier environment for creating. No, it hasn't.
Well, Emmanuel Macron has done. He lowered taxes. That was the emphasis, was lowering taxes and delivering a more business-friendly environment. That appears to have now changed, hasn't it?
Absolutely not. We've lowered taxes when you look at the profit tax over the last few years to bring it back to the average of European countries. We've also made it, when you look at rules and norms, we've made it a much friendlier environment to start a company, to start a tech company, and this is why you've seen a tech dynamism in France in the last few years. And of course, this is something that has to continue, because part of this effort will be to continue to keep investors in France, to keep companies in France, to have French and foreign entrepreneurs create companies. This is something that it will be absolutely key, because part of this effort, of course, when you look at reducing spending, tackling deficit, is also about keeping growth. Right now, France has a higher growth than some of its neighbors. And of course, that will be part of continue to bring income to the country, and to be able to tackle this deficit issue will be to continue to have growth. We're very aware of this. This is a business-friendly government.
Are you, in that context, though, Minister, good morning, are you worried about the wealthy in France deciding to leave? There might be lots of other European countries also putting up taxes, but some people's eyes might be drawn to other parts of Europe where that's not happening, or to the Middle East, to Dubai, for example. I am worried about the impact that high debt and deficit will have over the sovereignty of our country, will have over the wealth of future generations. And I think this is something that's shared by the French across the board, including the wealthiest, including the entrepreneurs. And so this is why we're sending this message of responsibility for the future. But at the same time, once again, as I said, you've seen France become a dynamic place for growth, for tech, for entrepreneurs, for outside investors, and this is something that will continue. This is why the tax hikes that we're talking will be very targeted and proportional on some. We're talking about a few hundreds of the wealthiest companies and individuals, and they will be temporary, and that's something that's really underlined in the budget that was unveiled today. OK, temporary, and that's something that, the President has underscored as well. Diving into some of the individual businesses or sectors that are in focus in France right now, Minister, I wonder if I can ask you about the cognac sector. We've seen China decide to put tariffs on French cognac, and this sector feels a little, we understand from our reporting, this sector feels a little sacrificed in this trade battle between Europe and China that perhaps started with cars. Are you going to do something to support the cognac makers?
First, I want to say there's no legal backing to this decision that was made, and all the cognac producers have been very upfront and very transparent in the investigation. There's no subsidy or no illegal practice by them. The truth is that what we've seen is the Commission has launched an investigation on some of the unfair trade practices by China on electric vehicles, and has proposed putting tariffs, proportional tariffs on these electric vehicles, because once again, we want a level playing field on trade, and it's completely natural. When you look at the United States, under the Biden administration, they've put 100% tariff on Chinese electric vehicles. There's no reason why Europe should be more naive or should less defend its interest than its other trade partners. So we France, we support, like our partners in Europe, the decision by the Commission to impose tariffs. Now, when it comes to retaliation, once again, there's no legal backing to it. The Commission has announced that compensation mechanism will be put forth for producers, and that's something certainly that we will support.
So are you going to provide some support to that sector specifically?
As I said, this is something that's already been said by the European Commission, that we will put forth compensation mechanism, and I think that's only fair indeed. And once again, this is beyond just the specific sectors that are being that we're talking about. This is a broader issue of a fair level playing field at trade level. If we want, and once again, we want Europe to be open to trade, we want to be able to export, we want to have dynamic trade relations with our partners, but we shouldn't be naive. We shouldn't not defend our interests when we see others like China and the United States who do it. The United States has put 100% tariffs on Chinese electric vehicles. There's no reason why, faced with the same subsidies, faced with the same issue of unfair practices, the European Union should not be able to defend itself.
Minister, you talk a lot about the trade between Europe, France versus China. Let's talk about Europe and France versus the United States that you're talking about. There are still impending steel tariffs, steel quotas even, that have been imposed from the United States on Europe. We have a new president in the States in just under 3 months. What are you asking for in terms of those negotiations? How are they going? How are you preparing for them when it comes to the steel conversation?
You know, I regret that we've seen some of the same protectionism under this administration and under the previous administration, and that's something I think that, you know, Europeans should look at and think about. You've seen the IRA also that was decided by the United States quite unilaterally to protect its own industry, to protect some of its companies and sectors, and sometimes at the expense of trade partners and allies. And so, as I said earlier, I mean, Europeans should not hesitate also to be able to support their own industry, to invest massively in the green transition, in the technological transition, and defend their own interests. I do hope that whatever comes out of the US election will keep a partner that we can have a robust dialogue with, but I also fear that we'll see a trend towards protectionism, towards isolationism. I think that would be in no one's interest, but in that case, Europeans should not hesitate to be able to defend their own interest. The key here at the European level, when you think about trade, but also other issues like geopolitical issues, is to stay united and put a united front in these negotiations.
Mr. Some strong words there in terms of competing with the United States that you say is unilaterally imposing these kind of protectionisms. Does France have the money to actively compete, to subsidize the sectors that are under threat from programs like the IRA?
You know, I was very interested in the report that was put forth recently by Mario Draghi, the former chairman of the European Central Bank. And what he underlined is the lack of competitiveness and the growing lack of competitiveness and productivity that you see in the European Union, especially when you compare it to the United States. The United States has been able to mobilize massively public, like private investment into artificial intelligence, into quantum, into a lot of innovative technologies that will be key to shaping and determining the future. This is something that Europeans should look at. We have to be able to mobilize both public and private savings to invest massively into our future. We also have to be able to lift some of the regulatory barriers that we have too much in Europe when you think about integrating capital markets. This will be absolutely critical in the coming years. We'll have a new European Commission in the next few months, basically at the start of 2025, that has to shape the agenda of the Commission.
Minister, I hear what you're saying, and I don't think there's any pushback against yours or Mario Draghi's take on that. But my question stands, does France have the money to act on the issues that, as you point out, Mario Draghi and yourself say is chief? Do you have the funding to address those issues?
But this is not only about France. I mean, we have 27 countries at the European level, and this is a challenge, I would say an existential challenge if we want to stay relevant on some of the key geopolitical, technological issues that will be shaping the future. This is a challenge that we face together, and this is why, you know, these conversations need to be held at the European level. But if I can come back actually on your question to the issue that we were talking about a few minutes ago, this is also why when we want to be part of the conversation, when we want to have the credibility with our partners to discuss these issues, this is why we have to tackle our deficit. This is also why, you know, France has, I think, a key role to play, an important voice with our partners at the European level. But it's true that we are expected on the deficit issue, and this is why you have this budget of credibility and responsibility that's being put forth today. Also, not only to protect France's future and sovereignty, but also to be a robust part of the conversation at the European level.
All right. Benjamin Haddad, France's Minister Delegate for European Affairs. We appreciate your time this morning covering a slew of issues. We thank you so much. Well, it's that very conversation that, of course, is spreading around the world, I suppose exclusively with the State Department Under Secretary who covers energy, critical minerals, and the environment, about that competitive factor the minister was just talking about. Take a listen to my exclusive conversation in Madrid.
We're all facing the same headwinds. And something that I can tell you is that we are working quite closely with our European counterparts through the EU and also with individual countries. All of these countries, not just Portugal, not just Spain, they're facing some problems that are caused by overcapacity in Chinese production. So, for example, in the automobile sector, competition from China is undercutting European cars, and a lot of that is that it's state-owned enterprises that don't really have a profit and loss model. They're getting subsidies. They're not paying rent. They're not paying taxes. If they lose money, they just get more money, and they are, the companies in Europe have come to the conclusion that that kind of industrial policy is not fair. And it's not helping their companies, it's not helping their workers.
Well, part of your title, of course, includes covering not just energy, but the environment as well. I'm curious what we're learning from Europe in that regard. You talk about this investment in the United States in this renewable sector, in the EVs, batteries that you're talking about. Europe was very far gone in that process, arguably more far along in that process than the United States was. You saw it in the UK, in France, in Germany as well. But it's an expensive process, not just in terms of creating those plants and creating that change in manufacturing, but creating the public infrastructure to support it. Charging stations are one example. Mm-hmm. Because of that cost, you've seen a lot of European governments, the UK, a little bit of France, certainly Germany, pull back on some of the goals and quotas and support that they provided that EV infrastructure, say, a couple of years ago. Are you worried about that happening in the States, that all the progress you're referring to getting turned around in 2 short months?
I think no one assured us that this would be a linear progression. This is business. You have ups and downs. But the numbers don't lie. In many parts of the U.S., renewable energy is cheaper than fossil fuel energy. The kinds of investments that are, for example, the CHIPS Act, $52 billion. About 80% of that has already been spent. For every dollar in the CHIPS Act that we have provided for investment, the private sector has brought in $11. So it's a huge. We're providing the seed money for the new technologies. That's not stopping. I think companies, the private sector sees the progression. They see the future. It's the energies. It's the industries of the future, and they want to be part of that. So yes, we're seeing, for example, in the mining world, the price of lithium plummeting from $80,000 last time I looked a ton to about $10,000 a ton. That's a problem. That makes investment harder. It makes financing harder. But at the same time, you're seeing the demand for lithium, even though the prices are plummeting, go up by about 30% last year.
The U.S. State Department Undersecretary for Energy, Critical Minerals, and the Environment, Jose Fernandez, there joining me exclusively. Coming up on the program, we're going to look ahead. J.P. Morgan, Wells Fargo reporting third-quarter earnings ahead of the U.S. market open today. More on what the investors are watching out for next. Stick with us. This is Bloomberg.
Welcome back. 8:52 in London. The market is pretty flat this morning. We are looking ahead, though, to bank earnings out of the United States later on this morning. JP Morgan will be in the headlines today alongside Wells Fargo as they kick off the U.S. bank earnings season. Analysts will be keeping a close eye on a host of topics: trading revenues, IB fees, just 2 of them. Let's talk to our finance reporter, Jenny Serrain, who's with us this morning. IPO market's pretty muted. We heard that from JP Morgan's Jamie Dimon earlier on this week. That could be one of the themes around investment banking that we're looking at.
Yeah, no, I think that's exactly right. I think, a lot of this quarter is really going to be more about what the executives say on the calls rather than probably what a lot of these numbers are going to show. So obviously, yes, I think equity underwriting is still pretty much in the doldrums. We've seen a little bit of a pickup in merger activity, but probably not enough to really write home about. So I think the investment banking side of the house is still pretty quiet. The other big number that we like to look at a lot for these banks is net interest income. And with rates being as high as they have been in recent years, that's been a really standout number. But we've already started to see the central bank obviously take rates down. And so I think a lot of it will just be more around the commentary of what these executives want to kind of communicate about how they're feeling about the future of these businesses.
Is this a macro event? What am I going to learn about the U.S. economy?
I mean, I think a lot of what you're going to hear today is, how they're feeling about how quickly the Fed might take rates down and how that might play out into their balance sheet. So far, consumers are still kind of hanging in there. So I don't think we've really seen a lot of that pressure that folks really thought folks would come under. Provisions are still expected to be really, really low. Credit's looking pristine. So it shouldn't be too much of a macro event, but there's always the chance for surprises.
So in addition to all the bank stories in the last 24 hours, or in the next 24 hours, we're also looking at the last 24 hours. TD Bank getting a $3 billion fine and some pretty severe penalties and restrictions coming out of the U.S. regulatory environment. Take a listen to what Attorney General Merrick Garland had to say.
TD Bank pled guilty to multiple felonies, including conspiring to violate the Bank Secrecy Act and commit money laundering. TD Bank has also agreed to a $1.8 billion criminal penalty. Combined with civil enforcement actions announced today by other agencies, the United States will be imposing a total of approximately $3 billion against TD Bank.
Jenny, weigh in here. This is a top 10 bank in the United States. They're really known for their acquisition strategy. How much of that announcement puts that in peril?
So they're now facing a cap on their growth, which is probably the most extreme measure that regulators can take against a bank in the U.S. And you're exactly right. They've really made their name going out and doing these really big deals lately. So I think at the very least, we won't expect to see them doing much of that anymore. I think the CEO had it right. He said this is a dark day in TD's history. Everything that was described by both the DOJ and regulators yesterday, it was pretty severe lapses for many, many years. And so this is a bank that's going to have to kind of crawl its way out of this mess for many years to come.
Jenny, thank you very much indeed. Jenny, looking ahead to these bank numbers, we're going to get a little bit later on. After we've got through that, we are going to be almost to the weekend. Now, clearly, we're going to be having to watch what we get out of the Chinese Finance Ministry tomorrow. But if you're not watching that, there are other things potentially you could be watching. BFI London Film Festival kicks off this weekend. The Montmartre Grape Festival.
Yes,
which
excellent.
Sounds excellent to me.
And if you overdo it there, and if you overdo it at the Berlin Food Week, I also noticed there is a marathon in Budapest, so you can, get to Budapest by the end of the weekend.
So you drink, you eat,
watch a film,
watch a film from London to Paris to Berlin, which you can do because it's Europe, and then you run a marathon and be ready for Monday.
Yes, and if you like the NFL, you can get back in time for that. And if you don't, you can stay away until it's finished.
Yes, a game which apparently you don't play with your feet. That's called football. Anyway, that is it for the opening trade. The Pulse is up next. Have a great weekend, everybody. We'll see you Monday. This is Bloomberg.